Hello everyone. Today in this video we are going to talk about the capital gains. We will talk that what is capital gains, its types and how to calculate the capital gain. So let's start with it. The first thing that we are going to talk about is the meaning of capital gain. A capital gain is an increase in the value of an asset or investment resulting from the price appreciation of the asset or investment. In simpler words, the gain occurs when the current or sale price of an asset or investment exceeds its purchase price. Capital gains are attributable to all types of capital assets, including but not limited to stocks, bonds, goodwill, and real estates. So basically, a capital addition is an expansion in the estimation of an advantage or speculation coming about because of the value valuation for the benefit of venture. So let's take an example to understand it. Let's suppose that you bought 1,000 shares of Reliance Industries of rupees 1,000. So it will be 10 lakhs. Now, let's suppose that you sold these 1,000 shares at the price of 2,000. That means double the price at which you bought it. So you will sold it at 20 lakh. The difference of 10,000, the difference of 10 lakh will be your capital gain. That is what we read in the definition, that it is an increase in the value of an asset or investment resulting from the price appreciation of the asset or investment. And in simpler words, we learned that the gain occurs when the current or sale price of an asset or investment exceeds its purchase price. In the example, the purchase price was 10 lakh and the selling price was 20 lakh. The difference of 10 lakh was our capital gain. Now, moving to the classifications of capital gain. Capital gains can be classified into two categories. Capital gain can be realized or unrealized. The realized gain is the gain from the final sale of an asset or investment. Conversely, an unrealized gain arises when the current price of an asset or investment exceeds its purchase price, but the asset or investment is still unsold. Note that only realized capital gains are taxed, while unrealized capital gains are merely paper gains that are usually subject to accounting reporting but do not trigger a taxable event. Now, the capital gain can also be classified as short term gains or long term gains. Short term gains occur if an investment or asset was held for less than a year. Long term capital gains are gained from an asset or investment that was held for more than 1 year. So these are the two classifications of capital gain. For one, they are classified as realized or unrealized. That is, when the asset or investment is sold, then it is realized, and when it is just on the paperwork, it is unrealized. The other type was short term gains or long term gains. When asset or investment is held for less than a year, then it is short term gain. And when it is held for more than 1 year, it is long term gain. Now, moving to the types of capital gains. Depending on the tenure of holding an asset, gains against an investment can broadly be divided into two types: short term capital gain and long term capital gain. So, the first one that we are going to talk about is short term capital gain. If an asset is sold within 36 months of acquisition, then the profits earned from it is known as the short term capital gains. For example, if a property is sold within 27 months of purchase, it will come under short term capital gains. Now the long-term capital gain. The profit earned by selling an asset that is in holding for more than 36 months is known as the long-term capital gains. After 31st March 2017, a holding period for non-movable properties was changed to 24 months. So, as I have told you earlier as well, that short-term capital gains are those which are held for less than a year, whereas short-term capital gain is that type of gain which is realized after 36 months. The profit that is earned by selling an asset for holding it more than 36 months, it is long-term capital gain. And when the profit is realized by holding it within 36 months, then it is short-term capital gain. Now, moving to next thing is that how to calculate short-term capital gains. So, before we start calculating the short-term capital gain, there are a few terms that you need to understand. The first term is full value consideration. The consideration received or to be received by the seller as a result of transfer of his capital assets. Capital gains are chargeable to tax in the year of transfer, even if no consideration has been received. The second term is cost of acquisition. The value for which the capital asset was acquired by the seller is the cost of acquisition. The third term is cost of improvement. Expenses of a capital nature incurred in making any additions or alterations to the capital asset by the seller is cost of improvement. So, full value consideration is the amount received by the seller as a result of selling it or transferring of his capital asset. Cost of acquisition is the amount that the seller has spent on acquiring that asset, and cost of improvement is the amount that the seller has spent on that capital asset to improve it or to keep it working. Now, we will see that how we calculate short-term capital gains. So, step 1. Start with the full value consideration. Step 2. Deduct the following, that is, expenditure incurred wholly and exclusively in connection with such transfer. Second, cost of acquisition. And third, cost of improvement. Finally, step 3. This amount is a short-term capital gain. So, to calculate short-term capital gain, first we have to start with full value of consideration. Then we have to deduct expenditure incurred wholly and exclusively in connection with such transfer, cost of acquisition and cost of improvement. We have to deduct all three things from the full value of consideration. And step 3 is the amount that is referred to as short-term capital gain. So, short-term capital gain is equal to full value consideration less expenses incurred exclusively for such transfer, less cost of acquisition and less cost of improvement. So, short-term capital profit is full value consideration. Now, moving to how to calculate long-term capital gains. So, step 1, start with the full value of consideration, same as short-term capital gain. Step 2, deduct the following, that is, expenditure incurred wholly and exclusively in connection with such transfer, indexed cost of acquisition, indexed cost of improvement. And the final step is deduct the resulting number by the tax exemptions provided under Section 54, 54EC, 54F, and 54B. So, long-term gain is full value consideration, less expenses incurred exclusively for such transfer, less indexed cost of acquisition, less indexed cost of improvement, less expenses that can be deducted from the value of consideration, and the step 3 is to deduct the resulting number of tax exemptions provided under the following sections. The sections are 54, 54EC, 54F and 54B. So, this is the way that that we calculate the long-term capital gains. Now, long-term capital profit is equal to full value consideration less expenses incurred concerning such transfer, less index cost of acquisition, less index cost of improvement, and less expenses that are eligible for a deduction from full value for consideration. So these are the two ways to calculate the long-term capital gains. Step 1, step 2, step 3, and here is the summary of that. Now, this is the picture that has also shown the steps to calculate short-term capital gains. The first one is sale price, or we can say full value of consideration. In the next step we have deducted expenditure incurred wholly and exclusively in connection with such transfer. After deducting it from full value of consideration, we get our net sale consideration. Then we have to subtract cost of acquisition, that is our purchase price, and cost of improvement from net sale consideration, and we will get our gross short-term capital gains. Now, in this picture, we have just calculated our long-term capital gains. The first step is to start with full value of consideration, or what we call sales price. In the next step, we deduct expenditure incurred wholly and exclusively in connection with such transfer. Then we will get our net sale consideration. Then we have to deduct indexed cost of acquisition and index cost of improvement from the net sale consideration. What we will get? We will get gross long-term capital gains. But as we know, that is subjected to taxes as well. So we will deduct exemption, if any, available under the following sections from the gross long-term capital gains. And then we will get our net long-term capital gains. Calculation of long-term capital gains, again, the steps are again the similar. First we will use our sale price, then we will deduct the expenses related to sale, index cost of purchase, index cost of improvement. We will get our gross long-term capital gains, and then we will deduct the exemptions if we are having any, and then we will get our net long-term capital gains. So in this video we have learned that what is capital gain, what are its type, what are its classification, what are two types of capital gains, that is short-term capital gains and long-term capital gains, and how to calculate both the gains. Thank you.